When it comes to ETFs like ULTY, which use option income strategies such as covered calls, as well as credit spreads and protected puts as of their most recent change, there's often a major disconnect between what investors expect and what's actually ideal for income generation and portfolio growth. Now let's break down the market environments, bull, bear, flat, and volatile, and identify which conditions are best suited for ULTY and other option income ETFs. Now a quick overview of ULTY if you're not already familiar. It is a weekly paying ETF. It holds 15 to 30 volatile stocks of their choosing that the fund managers are bullish on. And these are constantly changing. They're constantly adding and removing different underlyings, selling options on these underlyings to get that option premium and harvest the volatility, as well as buying protected puts on these underlyings in case these stocks end up free falling. And there's been many cases where some of these underlyings have taken a huge dip. One scenario was HIM's stock. It had a really bad earnings call and dropped 30% in a single day, but ULTY didn't really feel an impact from that one underlying because of their protected puts, which helped reduce the downside. But the main appeal is going to be this 85% distribution rate. Now volatility right now with ULTY is pretty high, especially with all the tariff talk going on. It's making the market very volatile. But this weekly distributions is really why people are buying into this ETF, and it's pretty consistent. We can see we're having an upcoming payment of 10 cents per share again, which is going to be an annualized distribution rate of about 85%. Absolutely amazing, and it's been very consistent, especially in these market conditions where it's actually most ideal. And unlike other income-focused ETFs, we can see every single week we can reliably receive between 8 and 10 cents per share, and it's been doing that ever since March, which is absolutely amazing. And it shows that this ETF can work under the right market conditions. Now, while this ETF used to have over 100% distribution rate, we are trading some of that distributions for some downside protection with those protected puts. And now we're seeing really closer to 70 to 80% distribution rate in exchange for some protection, which is really what everyone wants. They don't want a complete free fall of the ETF. We do want to see times where the fund can stabilize and even in some cases recover, which we saw from Liberation Day, which was April 1st. And it did have a pretty good recovery, which is something that this fund really never would have had before the change in strategy. But in this video, we're going to be going over how ULTY should perform and what you can expect from this ETF under different market conditions. As we all know, since Liberation Day, it has been a massive bull run, so many stocks and ETFs have been doing really well, ULTY included. But we have to consider that this is not always going to be the case, and markets will definitely be changing sometime in the future. But first, we have to understand what exactly a covered call is, because it plays a big role with ULTY. Now, at the very top level overview of a covered call, I like to think of it as getting paid to place a limit sell order for 100 shares. Because remember, you're selling call options against your underlying. In return for selling a call option, you're going to get paid a premium. As we can see with this chart, you do have a capped upside. Whatever strike price you choose, if the underlying shares of that stock go up past your strike, you have to sell your shares at that strike price regardless of whatever the stock price is at expiration. But if you're selling out of the money covered calls, you do want the underlying to go up in value. It's still a bullish position, but you don't want to be too bullish because you're going to miss out on those extra gains. And of course, since you are a shareholder, you do have all of the downside risk if the underlying shares end up free falling. Now, while we're in a raging bull market, that is probably the best case scenario for ULTY. But we do have to keep in mind that if we had held some of these underlyings that ULTY were holding, such as Robinhood stock, we would see close to 100% gains on some of these underlying securities. But that shouldn't let you stray away from ULTY, because we are in this for income, for consistent, reliable weekly dividends, and it really has made a lot of people a ton of money. So in a bull market, you are going to have the best case scenario with ULTY, because of course you want to be bullish on the overall market, the underlying holdings. But if the bull market continues, you could leave some growth on the table, which is not too big of a problem. Now in a bear market, you are also going to have likely some pretty high volatility. And we actually saw this with Liberation Day from March, April. So you're going to have high option premiums. We saw during April, we had some 10 cents, 9 cents, all the way to 11 cents in May. So high option premiums. This is going to lead to higher distribution rates, because remember, even though this was paying out like a 9-cent dividend, April 3rd, that share price was under $6. So it had a pretty high distribution rate, very close to 90%. But your share price did fall for ULTY, as with the overall market, which can hurt your total return. But it's good to know that even if the market crashes, you're going to get distributions much better than, say, a flat market. And that is going to bring us to our next point. We don't want to see something that is completely flat. If we head over to the NASDAQ, if we have a period of flatness, that means volatility is pretty low, which means that you might not necessarily lose in share price from ULTY, but you will definitely lose in a lower distribution rate, which is not ideal for many people. And we're actually seeing that right now with MSTY and MST, because the implied volatility is pretty lackluster. We've been really in this flat market with MSTR, and in turn, we're going to have a lower distribution rate with MSTY. And we can see based on the last distribution, it's around 80%, where previously it was well over 100%. So while MicroStrategy stock itself has not really dropped in price, that's not really been too good for MSTY, because it's all about that volatility, which gives us that higher distribution rate. Now, while everyone loves a bull market, the best case scenario, in my opinion, is going to be that kangaroo market, where the stock market overall is going to jump up pretty high, fall back down, and recover well. It doesn't matter if it results in a net neutral gain. That volatility of all that jumping around is going to create volatility, which we're going to be getting in the form of distributions with a lot of these income strategy ETFs, specifically ULTY for this video. Now, we've mentioned extreme bull markets, which we previously were in, and we've mentioned flat and kangaroo markets. One of the worst scenarios for ULTY is going to be down markets, periods of prolonged down and bear markets. Now, while a huge market crash can trigger high implied volatility, not really too ideal, since shares of ULTY will go down pretty significantly as well. But even a bear market where it's a slow bleed overall, that's going to kill the distribution rate for ULTY, and it's going to over time lower the share price of ULTY, which is of course less than ideal. Now, in order to recap for the different market types, in a nice bull market, which we've previously seen in the past few months, you're going to have pretty high income potential, very high NAV stability. ULTY has been absolutely amazing in this bull market, making people a ton of money week over week. But you're going to have that missed upside potential. If any of the underlyings end up going, say, 100%, 200%, you're not going to see that because it's an income focused ETF. Now, in a bear market, you're going to have also high income potential. Volatility is going to create high distributions, but you're going to have pretty low NAV stability. Combined with that 1.3% expense ratio, you could see some capital erosion as well. Now, my least favorite market is going to be the flat market, You're going to have low income potential and pretty low NAV stability as well, just because none of the underlying assets are growing in price. Nothing's really happening. This is the worst case scenario for ULTY. And at least in a bear market, when the stocks crash, that's actually one of my favorite periods of time to actually make money. Because if you're buying at those discounted prices, then you can get in at a lower share price. And then when the market overall recovers, you're going to make a ton of money with those recoveries. But the absolute best setup for ULTY is going to be that kangaroo market that we talked about when the ETFs or stocks jump up and down the overall market, because you're going to get that high income potential, pretty relatively stable NAV. And if you time it correctly, you can just set up limit buy orders and buy on all those dips, which means you're getting share prices at a very discounted price. And more shares, you're going to have more income. Overall, it's pretty cool. If you're chasing ULTY for weekly income, you have to understand that your ideal market is not necessarily a raging bull market. While it is very good, the kangaroo market, in my opinion, is a lot better. You don't want a complete calm market or flat market, which most people think, because the cover call strategy relies on volatility as well as some share price appreciation. And of course, market crashes are going to not be the most ideal for ULTY as well, but at least in those markets, you can buy more shares of ULTY at a cheaper price. And it's going to be likely very volatile, so you're going to have a higher distribution rate as well. Now let me know in the comments section below how much shares of ULTY you're having. What is your strategy for navigating different types of markets? We're not always going to see perfect bull markets like we've seen. So if the market does end up going in a prolonged correction, let me know what your strategy is. A lot of people are either hedging or just riding it out or just buying more shares.